Hello and welcome to Portfolio Matters Weekly Update Week 100. But before I get into it, I will read the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities we own or have financial interest in. Please do your own research or consult a professional investment advisor for making any decisions regarding topics mentioned on the show. Full disclaimer can be found at the end. Well, Happy New Year to all our viewers. This week, I am going to concentrate mainly on the data and on how all the various asset classes and commodities have performed over the past year. But we did have a little bit of news. So China appears to be reopening. They're having a COVID wave, but COVID restrictions appear to be off. Now, will that lead to a recovery in the Chinese economy in 2023? There is speculation that it will. I think it's too early to tell. We have some data for you. In Germany, day-ahead electricity prices actually went negative. So the European energy crisis has gone much better than expected, thanks to plenty of gas in storage and the warm weather. So this is China. This is New Year crowds in Wuhan, and COVID restrictions are definitely off. Now, if that leads to recovery in the Chinese economy, that could be bullish for oil and other commodities. But we'll show you in a bit. The latest Chinese PMIs are awful, and there is as yet no evidence to support a recovery in the Chinese economy. These are German day-ahead electricity prices, and warm weather and strong winds has led them to go negative, which is not what we would have expected 6 months ago. And finally, Tesla shares have had an absolutely terrible Q4. They're basically down around 60%. So the tech bubble is definitely deflating, as you might expect, given rising interest rates. Okay, on to this week's economic data, and there was a bit. So in the UK, we had nationwide house prices for December, and they were better than expected. So house prices fell only 0.1% in December against expectations for the 1%. Annual house price inflation came in at 2.8% in December, which was better than expected, but house prices are steadily drifting lower. In the US, we had Case-Shiller house prices for October. Reminder, Case-Shiller works by comparing the resale prices of existing homes to previous resale prices. So in October, the Case-Shiller house price index fell 0.8%, which was slightly better than expected, but is another negative number. So annual house price inflation was 8.6%, which was below expectations of 9.1%, and house prices in the US are drifting off. And the reason for that can be seen from the pending home sales, which are collapsing. So November home sales fell 4% month on month, much worse than expectation, and they fell 37.8% year on year. So far fewer homes are being sold in the US than in previous years. And reminder that a record number of new houses and apartments are being built in the US. So collapsing home sales plus record numbers of new homes being completed will lead to a huge rise in inventory next year, which will lead to further falls in house prices and a slowdown in the construction sector, which in turn should lead to a recession. In China, we had PMIs, and they were really bad. So the manufacturing PMI was expected at 49.5. For December, it came in at 47. But The biggest disappointment was in the non-manufacturing sector, which was expected at 48.4 and came in at 41.6, way down on November. The general was expected at 49, came in at 42.6. So the PMIs are portraying a Chinese economy which is deep in contraction territory. Some charts. So this is Case-Shiller House Price Index, which has been falling for the last 4 months. And as interest rates continue to rise in the US, I expect that to continue. And annual house price inflation in the US is falling. Pending home sales month on month have been falling steadily for the best part of a year. And the cumulative effect is that year on year, pending home sales are now falling at a near record rate. The Red Book retail sales growth figures show retail sales year on year, but reported weekly. And the data shows that during this December, US retail sales bounced back well, but remember these are nominal sales, and CPI in the US is currently 7.1%. So in actual fact, the strong retail sales in December were actually only 2% higher than in the previous year. But the US consumer certainly opened his wallet again in December. US initial jobless claims, no real trend. Continuing jobless claims are rising, and evidence that people who are out of work in the US are struggling to get back into work. Although, if we look at the long-term picture, the absolute numbers are still quite low. So the US labor market continues to be tight. This is China and the manufacturing PMI, not good, falling and in contraction territory. The non-manufacturing PMI is awful. So no evidence that the Chinese economy is yet recovering as lockdown measures are eased. Instead, the spread of COVID seems to be making things worse. The general PMI is also very poor. So in summary, the housing markets in the UK and US continue to slow, and the number of pending home sales in the US is contracting at a record rate. Reminder, the housing cycle is the business cycle. As the number of houses sold falls, so house prices should fall, then construction activity slows, leading to redundancies in the construction sector, and that creates a recession. The two sectors of the economy which shed jobs initially in a recession are manufacturing and construction, and both are slowing. In China, the PMIs for December were all disappointing. Now, how much of that is due to the current COVID wave? And when that is past, will the Chinese economy recover? The market seemed to be expecting a strong recovery in the Chinese economy next year. There is as yet no evidence of that. And on to one chart. Now, we have covered this before, but it bears reiterating. This is the chart of Italian debt to GDP by holder, and you will see that over the last decade, the ECB has effectively bought all new Italian bonds in issuance. And we know that the ECB is now stepping back. It's initiating QT, so it's aiming to sell down its holdings of Eurozone government bonds, and it's continuing to tighten interest rates. So that raises the question, who will fund the Italian deficit? Now, the TPI, the Transmission Protection Instrument, by which the ECB can suppress bond spreads throughout Europe, remains in place. But in order to suppress Italian bond yields, the ECB would have to buy Italian bonds equal to 4.5% of GDP this year, which would overwhelm the TPI. The TPI works by the ECB buying Italian bonds, say, but then selling an equal number of bonds from the core Eurozone, so Germany, Netherlands, etc. And overuse of the TPI would mean that the ECB's balance sheet would become dominated by the bonds of the periphery. Is that politically acceptable? So in summary, Italy is forecast to have a fiscal deficit about 4.5% in 2023. With the ECB no longer buying its debt, how will that be funded? Well, there are three possibilities. First of all, yields will need to rise until the private sector is willing to buy BTPs, but Italian bonds have an average maturity of just over 7 years. If Italy were to have to refinance all its bonds at current market rates, it would be insolvent. So rising yields on Italian bonds will threaten a solvency crisis in Italy. Second possibility is Italy cuts its fiscal deficit through structural reforms and wealth taxes. We know that actually Italy has a lot of private wealth that can be taxed. But that would mean cutting expenditure, raising taxes during a recession, which would then exacerbate the recession. There is very little chance of that happening, I would have thought. The third option is somehow the ECB suppresses the yield on Italian bonds. Now, it can do that to an extent through the TPI, or if that is insufficient, it could buy Italian bonds while continuing to raise interest rates, i.e., expanding its balance sheet at the same time as raising interest rates, which would invariably mean it would need to raise interest rates higher than it otherwise would. And is that politically acceptable? Would the rest of the Eurozone acquiesce to that decision? Essentially, it would mean a big fiscal transfer from the rest of the Eurozone to Italy. All that lies ahead of us. And as evidence that Italy needs deep structural reform, this chart shows the female labour force participation rate of various European countries, with Italy as the red line at the bottom. And you'll see it is about 15% lower than the European average. It's about 20% lower than Portugal, which has the highest participation rate. So what are the investment implications? Well, the current situation is unsustainable. Italy has a forecast fiscal deficit of 4.5% of GDP, and the market needs to know how that will be funded. I expect Italian bond yields to keep rising until there is a credible answer to that question. The ECB and the Eurozone tend to react only in response to a crisis, and I expect Italian bond yields to keep rising until there's a crisis, forcing the ECB to make a decision whether it lets Italian bond yields rise, possibly leading to a solvency crisis, which would then become a political and economic crisis and would essentially be a rerun of the Greek sovereign debt crisis, which followed the Great Financial Crisis and was resolved through a combination of deep budget cuts and debt forbearance. Will the same happen here? Or the ECB has to start buying BTPs, risking its inflation-fighting credentials, and essentially initiating fiscal transfers, which were explicitly forbidden in the foundation charter of the Eurozone. So, bottom line, expect a crisis before there's a resolution, which would be negative for Eurozone bonds and negative for the euro. Although in recent weeks, the euro has actually been strengthening. So the market seems unconcerned. Onto Inflation Watch, we had one piece of new data this week, which is from Japan. So in November, Japanese inflation ticked up to 3.8%. Reminder that interest rates in Japan remain negative at minus 0.1%, but they have widened the band on the 10-year to plus or minus 0.5%. And in recent days, they have been aggressively buying bonds in the market to defend the new upper band on the 10-year. So they're still expanding their balance sheet. We have a few charts related to inflation. This is shipping container rates, and you'll see that container rates from China to the US and Europe have collapsed and are pretty much back to their pre-COVID levels. So transport inflation has indeed been transient, although you'll notice that shipping rates between Rotterdam and the US remain high. I'm not sure what's going on there. If anyone knows, please get in touch. The other thing we know is that very high prices for shipping rates in 2021 caused shipping companies to invest in lots of new vessels, which are coming online in 23, 24, just as prices are collapsing. So you could see a glut and further falls in shipping rates over the coming year or so. These are UK electricity prices, which had a steep fall this week, although they remain well above 2020 levels. And this actually won't affect inflation in the UK because the government has capped energy prices for consumers. It will, however, reduce the cost to the taxpayer of the energy subsidies. So in summary, we know that global goods inflation has peaked, and there was further evidence of that from the fall in container shipping rates. This year, the question is very much whether service inflation will follow goods inflation down. Labor markets remain tight and wage growth elevated, which means that in order to reduce wage growth, central banks will have to create some slack in labor markets, which means inducing a recession. And onto Recession Watch. We talked earlier about how pending home sales in the US were falling. Well, the rate at which they're declining is really unprecedented if you look at other Fed tightening cycles. 2022 is the red line. Previous Fed tightening cycles are all the other lines. And the combination of very high house prices in the US plus rapidly rising interest rates is destroying home affordability, leading to a collapse in transactions. But the collapse in transactions and the fall in house prices should not lead to a solvency crisis in the US, with lots of US home buyers being forced out of their homes because they have a lot of equity. And you can see here the rise in house prices means that US homeowners have much more equity than debt, and they should be able to release some of that equity to service their debts in the worst case scenario, or simply sell their homes. So a fall in house prices should not lead to financial distress in the US. Now, in the UK, most home buyers have either variable rate or 2 to 5 year fixed, whereas in the US, most home buyers are on 30-year fixed. And that means that UK home buyers are much more exposed to changes in interest rates. In the US, only new home buyers are exposed to changes in interest rates. In the UK, it's existing and new home buyers. And the chart on the left shows that In the pink and green, interest rates over 2 and 5 years spiked in September during the shenanigans surrounding the Truss government, but have since fallen, whereas interest rates on mortgages rose sharply and have stayed high. Now, next year, 4 million UK households will face rising mortgage bills, and a further 2 million by 2025. So in 2023, lots of homeowners will be forced to divert expenditure to mortgage payments from the rest of their budget, leading to a fall in demand and deepening the UK recession. The monetary transmission mechanism in the UK will be much faster than in the US. Now, one of the things that we have been predicting on Portfolio Matters but has yet to come to pass is a financial crisis of some kind caused by the rapid rise in interest rates. In every other tightening cycle, rapidly rising interest rates reveal some severely over-leveraged entities which then collapse. Thus far, collapses have been mainly confined to crypto. But this chart shows that in the US, the quantity of distressed bonds and loans has quadrupled in the past year. And unsurprisingly, most of that is concentrated in the real estate sector, where interest costs are rising, home sales are falling, and house prices are falling. And this chart shows that corporate leverage in the US is at a record. So the blue lines are average debt divided by EBITDA. So in 2022, earnings held up well. As the US goes into recession in 2023, we expect earnings to fall and therefore debt to EBITDA to rise further, causing distress and insolvencies. And talking about a recession in the US, this is the Conference Board US Leading Index, 6-month change, and the Conference Board Leading Indicator is falling at a rate that has historically always been associated with a recession. So this is very much forecasting recession in the US in the coming year. And the black line here is the global credit impulse, which is falling. So the flow of credit is contracting, which suggests a global recession is likely in the coming year. Although, if we look at the US, bank loan growth is actually very strong. But history suggests loan growth tends to contract during a recession rather than prior to one. So it may be a lagging rather than a leading indicator. We now have some charts about global exports, and the brown line is the global export composite indicator, which is strongly negative, the worst it's been since 2009. So global trade is falling, which suggests a recession is coming. The main contraction appears to be in exports from emerging markets, presumably to developed markets. And this chart shows nominal exports as opposed to real exports, and they are also declining quickly. The grey line includes preliminary figures for November. And you see the brown line, which is the whole database, is highly correlated with the grey line. And the grey line is suggesting that nominal exports are falling very quickly. And it's not just volumes that are falling, prices are also falling. And prices are falling for both manufactured goods and commodities, although the fall in commodities has been much more marked. So in summary, global trade is contracting, and that is a forewarning of a pending global slowdown. Rising interest rates in the US are causing a rise in the number of financially distressed companies, and that number is likely to keep on rising as interest rates rise further and earnings start to fall as the recession bites in 2023. Okay, onto other charts. Well, this is rather a depressing chart if you're a Brit, because it shows median household income in various Eurozone countries and the rest of the world. The UK economy has struggled ever since the great financial crisis, and we are now very substantially worse off than our former colonies in the US, Canada, and Australia, and much worse off than our counterparts in Germany and France, and the trends do not look good. Now, I have read some commentary on these figures, and no one is quite sure why Britain is falling further and further behind. The best answer I have read is that we invest very little, and that is coming back to haunt us. If we are to raise our growth rates, we need to invest more. And after that, we need some good news. And there is some good news. So this is a sodium sulfur battery. Now, sodium sulfur batteries have been around for a while, but they haven't worked very well. Well, last week, researchers at the University of Sydney announced they've dramatically improved the performance of sodium sulfur batteries through a few simple tweaks. And the advantages of sodium sulfur batteries are that the ingredients are readily available from seawater and are much less toxic than lithium-ion batteries. And they also have 4 times the energy density of lithium-ion batteries and are cheaper to produce. Now, commercialization is at least 5 years away. But that is all great news, because we previously talked about the energy transition and how there simply aren't enough metals in the world to convert the entire energy system to renewables, because we need far more lithium and nickel than is actually available. Well, technology is improving at a pace, and if we can switch to sodium sulfur batteries, which use much more abundant materials, then the energy transition becomes much more plausible. And on to equity markets. Well, I'm going to concentrate on performance over the year. The all share actually wasn't too bad, down 3.2%, although, of course, sterling was down 10% versus the US dollar. And the all share contains a lot of big multinational companies which earn in US dollars. So in US dollar terms, the all share was down over 13%. Stocks Europe was down 12.9%. The Stocks Europe was down 12.9%, which shows actually decent resilience given the invasion of Ukraine and the energy crisis. The S&P 500, however, was down 19%, and the NASDAQ down 33%. So rising interest rates have been very bad for technology stocks. Reminder, technology stocks have expected earnings way in the future. And as interest rates rise, so the discount rate applied to those future earnings increases, and the present value of those future earnings falls, and hence technology stocks are expected to do very badly as interest rates rise, and that is exactly what's happened. The Hang Seng in Hong Kong had a poor year, down 15.5%, although it's had a good few weeks recently on expectations of Chinese reopening. As we've seen, the PMIs do not support that. Topics down 5%, again supported by a very weak yen. Bitcoin had a terrible year, down 64%. Sterling down 10.4% for the year, but well off its lows. Euro was down 5.9%. So sterling fell against the dollar and the euro. The dollar index rose by 8.2% on the year, and VIX closed the year at 21.7, which is far closer to sell territory than to buy. So this is the all share. It's had a very good run over the last few months. Same is true for the Euro Stoxx 600. The S&P 500 is fading into the new year. The NASDAQ is towards its lows for the year. The Federal Reserve is committed to continuing to raise rates and expect the NASDAQ to keep on falling in 2023. Hang Seng has had a big bounce. Topics actually not too bad on the year, supported by a weakening yen. Bitcoin, that looks like interest in Bitcoin is dying. Bitcoin is a speculative asset. The time to buy it is when it's going up. When it's going down, there's really no reason to hold it. This is sterling well off its lows. Euro, surprisingly, strongly rising as Eurozone bond yields have risen sharply, particularly in the last few weeks after Christine Lagarde's speech. Dollar index is fading. Now, as we talked about a few weeks ago, there's a great deal of dollar indebtedness in the rest of the world. And in order to pay the interest and capital on those debts, foreign holders of US dollar debt need US dollars. Now, they generally get those US dollars through exports to the US. The US pays for those exports in dollars, and foreign debt holders can then use those dollars to service their debts. Now, what happens during a recession is that the US cuts down on its imports. And so that means fewer dollars flowing to the rest of the world, which means that foreign debt holders struggle to acquire the dollars they need to service their debts. And they then have to search for other sources of dollars, which may mean selling assets or raising more debt. In both cases, it means buying dollars. So the dollar will tend to rise as the world economy slows. And we've recently seen a sell-off in the dollar. Slowing world economy could see it rise again. This is VIX. Very good strategy this year has been to buy VIX above 30 and sell it below 20. Well, currently VIX is at 21.7, far closer to sell than to buy. Some other charts. Well, this chart shows consensus earnings expectations for the S&P 500. That's white. And you'll notice those have fallen far more than consensus sales expectations, which are in blue. So the market is expecting US corporate profit margins to fall. And earlier in the year, we warned about that profit margins were very high by historic standards, pumped up by fiscal largesse during the pandemic, and they would have to fall. And that is exactly what's happening. And this chart shows the relationship between inflation and cyclically adjusted P/E ratios in the US. So as inflation rises, you'd expect the yield on US equities, the earnings yield and the dividend yield to rise in line with inflation. And so the P/E ratio to fall. Now, the P/E ratio has fallen, but nowhere near enough. So we expect the P/E ratio to continue falling, which means falling P. And if there is a recession in 2023 and earnings fall, then P will have to fall further. All of that is very negative for the US stock market. And although the S&P 500 had a very bad 2022, and there are lots of commentators online calling a bottom, we don't think we're anywhere near there yet. So the red line is the S&P 500 so far in this bear market, and the other lines are other bear markets. And you'll see that other bear markets have lasted longer and fallen further. And as long as the Fed is committed to keep on raising interest rates, I don't think you can call a bottom in the S&P 500. And fear is back. A month ago, we had a return of greed and a rally in the S&P 500. Well, it's fading off again. And on to commodities. In the last few weeks, we've had a bit of a bounce in industrial commodities in particular. And this chart shows that there is a correlation between the Bloomberg Commodity Index and global PMIs. But recently, the two have diverged. Global manufacturing PMIs have been falling, but commodity prices have held up. Now, going forwards, either global manufacturing PMIs need to recover and manufacturing conditions improve, or you'd expect commodity prices to fall further and close the gap between the two lines. And while we talk about commodities, a key driver of commodity prices over the last 20 years has been massive infrastructure spending in China. So China has been urbanizing and building vast quantities of urban flats and homes and the roads and railways to service those new residential apartments. But the population of China is now peaking and will start to decline. So going forward, you would expect less infrastructure will be needed and fewer new homes. So have we seen a peak in commodity demand in China? That would have negative implications for commodity prices. Onto energy commodities. Well, it was a very good week for Brent, up 5%. A couple of weeks ago, we had an enormous 10% fall in 1 week, and that has reversed. So Brent closes the year up 11%, WTI up 7%. European natural gas futures fell heavily on the week and actually closed the year up only 8.5%. So the European energy crisis has gone amazingly well. High prices earlier in the year incentivized LNG flows from around the world, which fully filled EU gas storage. So now we don't have a problem. We've also been lucky with the weather, which is unseasonably warm. UK natural gas prices also fell on the week and closed the year up only 4.9%. US natural gas prices also fell, but closed the year up 19%. US natural gas prices remain well below European ones. And in the coming years, new liquefaction plants in the US should increase the export capacity for LNG and close the gap in price between US gas prices and European ones. Coal ended the year up 130%. So coal supply has been constrained by ESG criteria, but during the European energy crisis, coal has been the backup power source. And uranium closed the year up 12%. Data specific to the oil market. Well, we had another big drawdown in US oil inventories, which fell 14.7 million last week, including the SPR, and 11.3 million excluding it. So the US was massively undersupplied last week, and drawdowns of this magnitude cannot continue from the SPR. At some stage, the US will have to start refilling the SPR and buying oil in the market, and that will support prices. I remain very uncertain about the outlook for the oil market. The current oil market looks tight. However, if we go into a recession, recessions normally lead to demand destruction and sharp falls in the oil price. But we know that there's been continued underinvestment, and as soon as the world recovers from the coming recession, I expect the oil price to bounce back very quickly. US oil production fell by 100,000 barrels a day last week to 12 million barrels, and on the year, it rose by only 200,000 barrels a day. So the world swing producer did not swing. Very high oil prices early in the year did not incentivize an increase in drilling activity and a rise in output. So capacity remains tight. And the Baker Hughes rig count fell by 1. So this is crude. It's had a strong bounce over the last few weeks. And the blue line here is CapEx. And you'll see CapEx has just not recovered despite a strong oil price. So going forward, we are not investing enough new capacity, and I expect supply to remain tight when we exit from recession, leading to higher oil prices very quickly. So there's been a lot of discussion about the reopening of the Chinese economy and the potential for that to lead to increased Chinese oil demand and rising oil prices. Well, this chart shows Chinese petrol demand. 2022 is in red, 2021 is in blue, and you'll see that actually 2022 demand has been very close to that of earlier years. Really, petroleum demand has held up incredibly well. So it looks like lockdowns really didn't affect the Chinese economy as much as the headlines would suggest. And if we look at diesel demand, the same is true. So that would suggest that the easing of lockdowns really won't change Chinese oil demand very much. The one exception is demand for jet fuel. And there you see demand really has collapsed. But demand for jet fuel is much lower than demand for diesel. If we look at diesel, we're talking about 2 million barrels a day, whereas jet fuel, it's about 600,000 barrels a day. So much lower. So full reopening of China would lead to a slight increase in oil demand, all of it in jet fuel, if we believe these charts. Now, this chart shows the performance of oil equities, and that is the blue line. That is the US index for oil and gas equities. And the orange line is Brent crude in US dollars. And you'll see that over the last year, equities have massively outperformed oil. We know that coming into this year, oil equities were cheap, and the market seems to have repriced them, leading to equities massively outperforming the oil price. Now, that doesn't appear sustainable. And if the oil price collapses in the coming year, then you'd expect oil equities to fall as well. Although whether they close that gap or not remains to be seen. But I always assume that oil equities will correlate strongly with the oil price. And in the latter half of this year, that has not been true. These are European natural gas futures, fallen right back to their levels at the start of the year. UK natural gas futures, the same. US natural gas futures up on the year, but well down from their highs. Coal, it's puzzling that the coal price has not followed natural gas prices lower. As natural gas prices fall, so you would expect that there'll be less demand for dirtier coal, and coal prices would fall. So I would be a seller of coal at this point. It's uranium not seeming to go anywhere. On to industrial commodities. Well, very much a mixed bag. Industrial commodities such as aluminium have had a poor year. So aluminium down 15%, cobalt down 26%, copper down 15%. But in recent months, the iron ore price has bounced back strongly, and construction and iron-related commodities have done okay. So chromium is up 9.1% on the year. Iron ore is up 1.3%. Ferrovanadium up 12.2%. Commodities related to the energy transition, such as lithium, have had a very strong run. So lithium closed the year up 92%. Neodymium, though, was down 14%. Tin down 36%. Zinc down 16%. So this is aluminium drifting off again. Cobalt, I very much question the timeliness of this data. Copper off from its lows but going nowhere. Chromium rising with the iron ore price recently. This is iron ore, which has had a very strong run off its recent lows. That seems to anticipate very strong demand from China due to stimulus and reopening. We will see whether that is justified. Lithium drifting off, but have had a great year. Neodymium recovering a bit. Nickel, well, nickel's had an extraordinary year after the shenanigans at the London Metal Exchange. And recent commentary is that the prices on the LME are divorced from the reality in the physical market, with the true price closer to $20,000 a ton. So bear that in mind. Tin off its lows. Ferrovanadium following iron up. Zinc drifting. A reminder that adding 1% vanadium to iron doubles the strength of the iron. On to precious metals. Well, precious metals having a strong end to the year. Gold up 1.5% last week. Silver up 0.8%. Platinum up 7.4% last week. Palladium up 7.7%. So over the course of the year, gold is essentially flat. Silver's up 3%. Platinum was up 11%. So the jewelry metals doing well. The industrial metals, rhodium and palladium, falling. Rhodium was down 13%, palladium down 5%. This is gold, and that seems to be a nice upward trend, which will please Richard. And when Russia invaded Ukraine, the US seized Russia's dollar reserves, so Russia's holdings of US treasuries. And that seems to have alerted countries to the danger of holding their reserves in the form of other countries' debt, in that it can be seized if you fall out with them. And so central banks have returned to buying gold. So this is the quarterly net purchases of gold by central banks. And you see it has shot up. And that puts the brown bottom and Gordon Brown's liquidation of the UK's gold reserves in context. This is silver, had a good run, which seems to be intact. Platinum, very good week and rising. Rhodium drifting off. Rhodium is mainly used in catalysts in the car industry. Recession will cause a fall in car sales and lower rhodium demand. This is palladium, also used in catalysts. Finally, on to rates. Well, it was a bit of a dull week for the UK yield curve, which was pretty unchanged. But over the Christmas period, the yields in the periphery of the Eurozone continued to rise and rise strongly. So Greek 10-year rose by 9 basis points, Italian by 20, and Spanish also by 20. Now, I would expect that as the economy slows, inflation slows, and therefore bond yields start to fall. And you'll see there's this historic correlation between global PMIs and US 10 years. So as PMIs are falling, you'd expect US 10 years to fall. But recently, that fall has reversed. And in the UK, we've seen strong rises in long-term bond yields, which has been very bad for my portfolio. But I expect as the world economy goes into recession and inflation comes down, bond yields fall in 2023. Now, I have been early, which equates to wrong, but that doesn't invalidate the trade. It means that I've been too early in the cycle. But when the cycle turns, I expect bond yields to come down. And we are currently in an environment of weakening economic activity and declining inflation. And you would expect bonds to do well in that environment. But so far, they haven't. This is the UK 10-year. Yields have risen a long way over the past month, and it is too early to call a top. Same with the 30-year. US 10-year is rising again strongly. The German 10-year is at a new high for the cycle and continuing to rise. Italian bond yield is back towards its highs. Greek 10-year is rising again. A reminder, most Greek bonds are held by institutions and it really is not exposed to market rates. If there's a crisis in the Eurozone, it will not be caused by Greece, it will be caused by Italy. And on to our views of the various asset classes, which are unchanged on last week, but to reiterate, I'm expecting equities to have a bad 2023 as earnings start to fall with the recession. Bonds, I have been too early and yields have been continuing to rise. But in the coming year, as the economies of the world slow down, inflation should fall and bond yields should fall with inflation. Gold, I am neutral on. I expect gold to do well when the interest rate cycle peaks and turns down, which is not yet. So I'd be waiting until the central banks start to cut interest rates before buying gold. However, gold has had a good couple of months, which has been very good for Richard. The danger is that in a crisis such as a stock market crash, investors need to sell their safe haven assets in order to meet margin calls. And if you remember, during the great financial crisis, gold fell by 30% as the stock market crashed before recovering strongly. So I would be waiting before buying gold. Industrial commodities, I expect to do badly as the world economy slows, and energy, I am very uncertain about. The physical market is tight. We have not been investing in new capacity, but recession means falling demand. That tends to mean a sharp fall in the oil price. So I will be awaiting developments rather than buying now. And this is the seasonality chart. We are in a bear market and January is generally bad for equities. Concluding comments. So Bond yields in the periphery of the Eurozone continue to rise in the period between Christmas and New Year, and I'm expecting some sort of a crisis in the Eurozone as the market needs to know how Italy will fund its fiscal deficit in the coming year in the absence of purchases by the ECB. Watch this space. And so far, the world economy has withstood rapidly rising interest rates surprisingly well. In the coming year, I expect that to change and there to be a sharp contraction in corporate earnings, which will lead to further falls in stock markets. Happy New Year to all of our 1,984 subscribers. We're getting close to 2,000. And finally, on to my own portfolio. Well, I had a poor week, down 0.3% as bond yields continue to rise. And that took me to plus 13% on the year, which is decent enough, much better than the all share, although well down from my highs. I had no buys, no sales. So the orange line is my own portfolio. The yellow line is the all share, and I frankly was doing very well until my recent mistimed purchases of long-term bonds. I'm down about 7% from my peak, but I still think it's the right trade. I've just been too early. Too early equals wrong. So this is the iShares US Treasury 20-year plus ETF, which I've sold back out of and has fallen back to its lows. I will be waiting to re-enter. And this is the 2071 gilt. Is that forming a bottom? He says, hopefully. Same with the 2068 index link gilt. The 2061 continues to fall. So in the coming year, I will be aiming to increase my exposure to long-term bonds and take advantage of falling yields as the UK economy goes into recession and inflation falls sharply in the UK. So far, I have been wrong, and that's cost me money, but that doesn't invalidate the trade. Happy New Year to everyone. Let's hope we have fewer governments in the coming year. A warning that the next couple of weeks, the publication schedule will be disrupted as we have various holidays and won't get back to our usual Friday schedule until the third week of January. In the meantime, I will be putting something out whenever I'm around. I think that is on Mondays. So the next one will be next Monday. Thank you all for watching. Please can you press like and subscribe to the channel. And it's goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.